Welcome back to the channel. So, when you hear of retirement, what comes to your mind? I guess it's right, old age. Is that what you think? No. You might be right and you might be wrong at the same time. Retirement doesn't have to be in old age only. There are people who choose to retire early, and you need to have planning in place so that if you want to retire early, you have enough money that can sustain you during that period. So, in today's episode, we are going to discuss top 10 ways that you can prepare for your retirement. Should you want to retire early or later when you attain the traditional retirement age, depending on your country. So, if you're new, my name is Sheila, and this is Sheila's World. You're welcome. And for the returning subscriber, I really appreciate you. We are growing and we are on the way to 1,000 subscribers. So if you haven't subscribed, please, before we continue, hit that subscribe button and the like button if you enjoyed the video. And then we are getting down to the topic of today. So stick around. First, we need to understand what retirement is. Retirement is basically the point in life when someone stops working. It can be either you've attained the retirement age depending on the country that you are in, or because of illness, or maybe it's just a choice of early retirement. So you need to have a plan for whatever reason you retire from your work so that you don't have those financial burdens after retirement. So retirement planning basically means you prepare today for that time that you will be no longer working. And according to statistics, especially in Kenya, every 10 people, 8 people have not planned for their retirement, or they have no idea what retirement means. The 10, only 2 people are prepared for their retirement. And again, they are not prepared fully because they're only prepared for at least 30% retirement fund that can cater for their retirement age. So you need to be very careful when you are thinking of your savings so that you don't forget your retirement. So I have come up today with top 10 ways that you can look into when you are thinking of your retirement. Because old age is something you cannot avoid. It's inevitable. So everyone will get old at some point. And if you don't prepare for it, we are going to fail. Would you rather be young with money and old without money, or vice versa? So it's important to know that in old age, expenses are very high. Medical expenses that comes with old age, living expenses, since you are no longer receiving your income from your employer. It's just prepare on time. When you are still actively working, you are going to suffer. And one of the things you need to consider first when you are thinking of your retirement, as much as your employer has a plan for you, that is if you're employed, do you know how much you're expecting from your employer? How much are you expecting? As per our retirement, our social security fund in Kenya, you contribute 200 and your employer contribute 200, so that's 400. So that is very little when it comes to your retirement money. It cannot be enough. If per year you're going to calculate, even if your employer is matching your contribution, if you're going with the minimum, 200, that's 400. In a year, how much is that? In your working years, maybe it's 20 years to your retirement, or some it's even 10. How long do you think that money that you're going to get at the end will sustain you? Life after retirement can be long. There are people who live even 30 years after retirement. Imagine you've retired at 60, but then you live 30 years more or even more. How are you going to survive if you've not had enough savings for your retirement? So that is why I came up with these ways that can help you so that you know what to prepare and what to expect when it comes to your retirement. When it comes to preparation is start saving. If you haven't started saving, if you have already started, keep saving and also increase your savings. If you have extra income, keep increasing your retirement fund. And also stick to your goals. Don't divert retirement money to something else. Just focus on your retirement. If you're already saving, well and good. There are so many ways that you can save for retirement. You can have your employer's pension fund that your employee is contributing part of it and you are contributing part of it. If you are in that plan, lucky you, because self-employed people, they have to plan for themselves. And so there is option also of personal retirement schemes or individual retirement schemes, where individuals who are not employed or who are self-employed can still open a pension plan for themselves and they start saving. So you don't have to be in employment for you to save for retirement. Old age is for everyone, whether you are young, old, employed or not employed. Old age is there to stay. So we have to plan whichever way, whatever we are doing, whether you're doing casual jobs, whether you're doing whatever job you're doing, just make sure you're putting something aside towards your retirement. So you just have to start with whatever you have. Start small. If your income allows, don't say that I'm earning less, I cannot afford. You can even start with the least that amount that you can, even if it's 500, just make sure you are doing something for your retirement, because it is very difficult in old age when you don't have money. You'll be forced to continue working even after your retirement age if you don't plan. So choose wisely, start early so that you don't start running around in your 60s looking for jobs, and no one wants to employ you when you're in your 60s, 70s. So it's important in our active working years, we just plan well so that we don't fail in our retirement. So retirement is just like going on a vacation, but you don't want to run out of money. So if for you to make sure that you don't run out of money, you need to start saving. We have enough time. For example, if you are currently, let's say 30s, in your 30s, and with our current normal retirement age in Kenya is 60. So you have 30 years to plan. Why would you wait to get to 60? Then you start complaining you don't have enough fund. And please don't rely entirely on your employer's pension fund. It's not enough. Especially here in Kenya, our minimum is 200 Kenyan shillings that you contribute towards your National Social Security Fund. Then your employer matches the same. If you calculate that amount, even if you're working for 30 years, it can never be enough to sustain your living standards. Because your current living standards, if you want to sustain it after retirement, you need like almost double. We need 70% of your current, your pre-retirement income is what you need after retirement. Since after retirement expenses are a bit high when it comes to medical expenses. Even if you have parents or grandparents, you can tell how much their medical covers cost. If you're in a country like ours where you have to buy to get medical cover for yourself, even in old age, it's quite expensive. It's costly for older people. So if you don't plan early, you might not be able even to take care of your medical expenses, leave alone living expenses, the basic living expenses. So find ways of supplementing what your employer is already giving you. There are so many avenues of saving towards your retirement besides just the pension. So talk to your financial advisor, talk to your bank, and even talk to your employer for alternative options that you can improve your retirement fund. So with that in mind, saving and saving more, that is the first starting point. The next thing you need to know is that find out what are your retirement needs. So experts estimate that you need at least 70 to 90% of your pre-retirement income to sustain or to maintain your standard of living after retirement. So if you look at your current income or your current living standards, how much do you spend? And then remember, after retirement, you'll need at least 70 or 80, and that is after you already own a home. Because don't wait until retirement again for you to start looking on how you're going to own a home. So home ownership should go hand in hand with your retirement planning. So once you have a home, the next best thing to do is having your retirement plan in place. So you need to have at least 70 to 90% of your pre-retirement income in your retirement fund for you to retire comfortably. So do your maths. Look at what your employer is giving you and find out, and then we'll supplement that whatever your employer is giving you. So don't just think that whatever your employer is giving you is enough. You need to find ways of increasing your retirement fund. So another point, the third way of planning for your retirement is make sure that if you are employed, you are contributing to your employer's retirement savings plan. Not every employer provides that, but if you are lucky and that retirement plan is in place with the employer, make sure you contribute towards it. But as I said earlier, find other ways of increasing that your retirement fund. You can save on the side. There are so many other ways that you can save. Just talk to financial advisors and they'll advise you for other better ways that you can still save for your retirement. Also learn about your employer's pension plan. Get to know how much do you actually expect to get at your retirement, because there's already a fixed age for retirement, especially if you're employed with the government. There's a fixed age of 60. You cannot continue working after 60 years. So get to know what are your benefits after retirement. How much are you going to get? What are the tax implications on your contributions towards your retirement? Are there benefits that you are going to get? Are there taxes that are going to be charged on your retirement fund? Because I know majority of people don't know about taxes when it comes to your retirement fund. There's find out, especially I'm talking about our Kenyan people, since it's the system that I understand well. Find out about, yes, you are contributing a certain amount. Then when you do a calculation, in 30 years or in 20 years time, I'll be receiving this much. But do you know how much tax you'll be paying on that amount? Just find out, because trust me, you'll be shocked. The tax is just too much. So find ways where you can save, just to save on taxes as well. There are better ways that if you find out or talk to me, I'll explain to you more about taxes. So just leave a comment below if you need more information. Then I can get in touch with you. So learn more about your employer's pension plan and the benefits that you're going to get. Then consider basic investment principles. Know how your pension is going to be invested, and also diversify your investment so as to reduce risk. So those are the basic investment principles that you need to consider when you are thinking about your retirement. Another rule when it comes to retirement planning, please don't touch your retirement savings, no matter what. I know there are ways that you can use your retirement to acquire a home, like a mortgage or something, but I'd rather tell you that please just let your retirement savings be retirement and get a mortgage on the side if it's for home ownership. Since, it sounds very interesting, like it sounds attractive, like that you can acquire a home using your pension savings, but it has implications, because at the end of it, you're reducing your fund that you're supposed to get at the end. So think about that. If you are approached about using your pension fund to acquire a home, please think twice or even seek second opinion before you go for that option, because this will actually affect your final retirement savings that you'll have at the retirement time. So if you withdraw your retirement savings now, you will lose the principal. and interest, and you may lose even the tax benefits. So make sure you just don't touch the savings. And if you change jobs, there are ways that you can transfer your fund either to your new employer or even to your own personal pension scheme. Organizations, most insurance companies offer personal pension schemes for individuals who are not employed. So if you move jobs or if you are fired or you're no longer working in the same place, make sure you consolidate all your pension from various places you've been working into your own personal pension scheme so that you're in control and you're able to know how the pension is growing, and also you can continue contributing towards it. So just don't leave your pension all over. If you moved employment, find ways of consolidating all your savings in one place. Another thing to consider when you're planning for your retirement is ask your employer to start a plan if you are working for an employer who hasn't started already. Yes, you have to demand for some things at times. There are people who are working in places where there are no pension funds at all. That's it. You need to demand for those are, can I say, rights, but they are mandatory savings that everyone should have. So if you are a group of people and you are employed, come up together and talk to your employer and say, we would like to have this. Yeah, the employer might be good and match your contributions, but if they don't, just do it on your own as a group. But it is easier when it's deducted directly from your salary towards the pension fund scheme. So if your employer hasn't started already, please gather with your other colleagues and ensure that they start something for you. Then another thing is, besides that employer's fund, as I said before, make sure you're also putting money for your personal or individual retirement account or plan. So besides that, employers have yours, so that, as I said earlier, in case you move jobs, you can easily just transfer your money to your individual retirement savings. So having your own on the side boosts the final retirement fund that you'll have at the end. So just look at those ways. Don't just concentrate on your employer's pension fund. It's never enough. Yes, I deal with the pensioners, and I can tell you what you discover when you are 60, and you cannot go back and correct that. It's just too late. So I'm telling you this early enough. If you're still in employment, find out about your pension. Open your personal pension scheme. Open alternative ways of savings towards your retirement, so that you don't regret in old age. Then just find out about your social security benefits. In Kenya, our NSSF. I'm sure most people feel secure that they are having a pension with NSSF. That is the government mandatory scheme for every employee. But the benefits there are very low and the taxes are too high. So just find out about the national security benefits, and you'll know better. You'll know where to put more money, whether it's that NSSF or you pump money elsewhere where you save more when it comes to taxes. So on average, social security replaces about 30% of your pre-retirement income. 30%. If you're earning 100,000 currently, which majority of Kenyans don't, very few people earn that amount. So can you imagine starting getting 30,000 Kenyan shillings from your usual 100,000? Will that not reduce your living standards? Because you're used to 100,000. So 30% is just 30,000. Seriously. And we need to have at least 70. As per the experts, they say we need 70 to 90% of our pre-retirement income to survive well when it comes to retirement. So 30% is so little. And that's why don't concentrate so much on the social security savings that we are doing with our NSSF here in Kenya. And in other countries, I'm sure you have your own social security fund or scheme. So finally, when it comes to planning, don't be afraid to ask questions. Ask your employer all the questions when it comes to your retirement benefits. Talk to your financial advisors. They'll advise you on other ways or alternative ways that you can boost your retirement fund. And also find out about taxes. On retirement, upon retirement, how much tax is going to be charged on my retirement fund? Is my retirement a pension? Is it a provident fund? Those are two different things, and which most people don't know. Are you going to take it as a lump sum? What are the effects when you take your pension as a lump sum at the end of your working life or on your retirement? So those are the questions, tough questions that you need to ask so that you are sure that you are having enough savings for your retirement. So as for me, my dream, when I think of retirement, I'm thinking of that time when I'm no longer using my pension in educating my children. It's money for relaxing. And that's why when you're doing your financial planning, budget well, budget for retirement, budget for your children's school fees or children education fund, budget for, just make sure you budget well so that you don't, your other needs does not affect your retirement savings. So I think that's all for today. If you enjoyed the video, please give it a thumbs up, hit that like button and subscribe, and leave a comment below and tell me what you think about today's topic. Is it something you've learned something on? Have you gained anything from today's topic? Do you understand your pension well? Are you among the two people in every 10 who have a pension fund? Or are you among the 8 who are not thinking of their retirement time at all? So please be smart and make smart decisions for your old age. Yes. Have a good day, and we'll talk again in my next video.